Welcome to Stocks in Translation, broadcasting from Yahoo Finance Studios in New York. I am Jared Blikre, your host, and with me is the people's voice, also known as Sydnee Freed. Please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Sherveen Mashayekhi, founder and CEO of the talent advisory firm Free Agency. He also hosts the live New York City pitch show, The Feedback Loop, which gives founders blunt investor-grade feedback every week. And today we're going to be talking about venture capital, startups, and yes, AI. Our word of the day is series, not in the baseball sense, but how companies raise money before they become public. And this episode is brought to you by the number 59,000. That's the number of tech layoffs this year through May, according to TechCrunch, and that's after 150,000 layoffs in 2024. Why this matters for everyone as tech feels the AI heat early. But before we dig in, Sherveen, just tell us your overview of what's transpired this year in your view in 2025, and we're almost halfway through.
Oh, the fact that we're almost halfway through is shocking.
Yes.
It's been a weird year. In tech, broadly speaking, it's been a funky year because AI is moving faster than the founders and venture capitalists can kind of keep up with. So you've seen basically just like, I'd say if you ask most tech founders, most tech commentators, they'd go, it's just been a blink. Then there's the politics and infusion of venture capital, kind of tech takes over DC theme that a lot of people are concerned about at the same time. So 2025 so far has been chaotic, and I think is probably in our industry a predecessor for a continuous tumultuous few years, AI continuing to outpace kind of how people can understand what's going on. Tech and politics continuing to converge in weird and interesting ways, and venture capital experiencing kind of transformation because of all of those factors. So yeah. Odd.
I'm with you 100%. And it just seems like we're at the beginning of this. We're going to dig into it. But now our word of the day, and this is series. Series, which could be A, B, C. It is the lettered tag for each round of venture funding. Every new series sells fresh shares and usually lands a bigger check at a higher company valuation. At least that's the way it's supposed to go. But tell us how the venture capital process works.
Yeah. So typically you're going to have an early stage company go through a variety of funding rounds, and these nicknames mean different things in different phases. And so you might raise a pre-seed round or a seed round of funding when you're an early stage business. This is when you might go to some angel investors or an accelerator. These are small money folks, either individuals.
And you're an angel investor.
I'm an angel investor myself. And so you might come to me for, as an individual, $1,000, $5,000, $20,000, depending on how wealthy I am. And then you might go to an accelerator or a small fund for a couple $100,000. Even those terms have been fuzzy over time. So pre-seed is kind of a recent machination because a seed round meant too many things. It could mean you raised $50,000 or you raised $3 million, and people could no longer tell the difference between what that meant for you as a business or what the CEO did in that moment. But then after that, you start to get to some standardization. So after you raise a seed round, let's say again, $500K all the way to maybe $2 million, you might raise a bridge round, another seed, but you eventually get to series A, B, C, increasing rounds of funding where investors are getting confident that when they put dollars to work, there's something they're betting on, a business model that's working or an approach that's working, and they want to go, hey, let's pour $5 million, $10 million, $20 million onto whatever's going on. And so we're actually a venture-backed startup ourselves. We've raised $15 million. One of those rounds is a $10 million Series A. So these are mostly so that there's common language around how much money is being thrown at a company and what sort of confidence
also,
level.
All you VC guys talk really fast. I've noticed it.
I also just talk extraordinarily fast. I get that feedback all the time, so I'm probably even in that crowd.
We welcome it.
I have questions about the seeds, but I'm also just curious how people even find angel investors.
Yeah.
Is there like a database?
Like, what's your phone number?
Yeah. So 201. No, so the hard part actually for a lot of first-time founders is this initial finding of the first set of investors, because you need an initial yes, whether it's an individual angel or if you raise later rounds, you need a firm to give you your first yes. Typically speaking, these are going to be, for most founders, and this is a bad thing about our industry, people you know. So you're going to need to somewhat be networked or find your way into that network. But if you're not somebody who has that network, then your initial few attempts are going to be going to events, finding, let's say, a tech accelerator. These are programs that will set up 3-month initial boot camps for early startups. There you can apply you can apply on an online form. But for the most part, again, you're looking to either be in that network already because of where you worked. Maybe you worked at a startup, maybe you met somebody who became a venture capitalist or an angel investor, or you're going to need to kind of break your way in through, again, an event, an accelerator, because you need them to introduce you. Let's say you do find somebody who gives you your first yes, they're going to only be $5,000, $10,000, $20,000 of your initial round. You need a couple $100,000 grand to get started, they're going to need to introduce you to others inside the venture capital ecosystem.
And why so many seeds? Because you said you could actually have multiple
Yeah.
pre-seed before you even get to ABC.
So this becomes the language of venture capital, right? And so the fact that we call something a seed round is not only a delineation of how much money you're receiving and at what sort of valuation, but also a sense of your progress. And so seed round companies typically still going to be a set of experiments at early stage team, not yet scaling to an amount of revenue. It depends on your business model, whether you're consumer or B2B. But by the time you get to Series A, or if you say you're raising a Series A, or you've raised a Series A, you're indicating to everybody in the world, whether you're partners, future investors, we have figured out our initial business model in the seed. We've made some progress. We're now betting on something that is working. Let's say we built a CRM for doctors. It's working to some extent. Now we're raising our
Customer
Series
relationship
A.
management.
Exactly. A database for all of your patients and your insurance companies, all of that. Maybe you go to your Series A because you go, okay, we're making $500K in annual revenue. We want to take this to the next level. We need to invest in more technology, but there's something here that's working. If you're raising, let's say you raise a Series B, you get to Series C. By the time you're at a Series C, again, this is just the language of venture capital. The amount of money or valuation can differ, but then you've really proven some revenue. You've probably been making $1, $5, $10 million on an annual basis, and you're saying there's even more to bet on. We want to scale our go-to-market teams. We want to do market expansion. We have competitors that are at our heels. And so, again, it winds up being a language in venture capital. Nothing is strict. And so, again, you saw Series A, let's say, in the frothy times of 2021 when venture capital was at its height. A Series A started to mean anywhere from $10 million being raised by a company to $100 million being raised by a company. And this is one of the critiques, I think, of the language of seed or series is this stuff, again, winds up being redefined based on the norms of the moment rather than being definitional.
I love moving goalposts.
Yeah, exactly.
But you just mentioned 2021 as a peak, and this led to my next question I was going to ask you anyway. 2022 was a terrible bear market in stocks and publicly traded stocks, but we also narrowly avoided recession.
Yeah.
And then we talked to a couple of VC people last year, and they said things were just finally starting to thaw in 2024. What is the market like now for funding?
It is very feast or famine based on who you are and what you're doing. And so the market overall for venture capital, and if we think about this as kind of the market of how do LPs, the people who fund these venture capital firms, think about this asset class, is not fantastic. The returns have not been great. There was a lot of hype funding that kind of started in 2018 to 2022 vintage at valuations that didn't pan out, into companies that didn't pan out. And a lot of this, again, is kind of being reevaluated right now from the LP base that invests in venture capital firms. So there's a drawback of overall dollars. Then you have the venture capital firms themselves who invest in startups. And they're nervous because there was a whole decade they basically learned from where they invested in startups, but the theories of growth, the theories of revenue didn't pan out.
Yeah, and we had ultra low interest rates. I mean, we're in a different
Exactly.
macro environment.
Exactly. And so now I think you have venture capitalists who are nervous, LPs who are not necessarily viewing the asset classes positively, except the winners. And so there are firms, funds, and even startups that did really well in this moment. There is still the positive outcomes. And so you have this flight to quality or the flight to perceived quality, where, for example, a venture capital firm that is investing in 2025 is being very cautious and going, what founders do I already know that are taking another crack at it? Or if you're an LP looking to invest in a venture capital firm, which venture capital firm do I already know? And where do I want to put those dollars? You have AI being obviously a huge buzzword for funding. And so you see a lot of flight to AI because that's the hype cycle. That does mean a lot of startups with more traditional or slow-moving ideas or maybe first-time founders are struggling. And so you see, again, this feast or famine kind of effect from it all.
Yeah, that seems tough. I'm curious, you said you raised, was it 15 million Series A? So what gets you to B? You haven't gotten B yet.
And we view, our path might not be continued venture capital, might be using venture capital we have so far to continue our growth. And that depends on every particular business. For us, let's say that we did want to continue to raise venture capital. For us, that market would be on revenue. Every business is going to be slightly different what sort of revenue that a Series B investor would want to see. So, we're kind of consumer services and orientation, so they probably want to see from us something in the realm of $10 million to be confident to do a Series B or Series C round of funding, versus if you're a B2B business where it's a little bit more repeatable in a hot space like AI, you might give that sort of company a Series B round just off of $1 million of initial revenue because you go, the growth is going to be explosive. Yeah, you don't want to miss out.
And we'll have plenty of time to talk about AI after the break, because I got a million questions. But just real quickly, if somebody's considering taking a job in a startup, like what what stage should the company be in to maximize their personal return? And what are the risks versus rewards in each of these different stages or whatever?
Such a lottery ticket. And so I advise so many job seekers, and they always ask me this question.
It's just a lottery ticket?
It's just a lottery ticket. Now, that's a lottery ticket that you influence, right? And so I think when I advise people on this, I advise a lot of people to join startups, and I go, do you like the potential of this company? Don't necessarily do the math and think, I'm guaranteed that my equity, especially there's options that you have to actually purchase over time. There's a whole bunch of mechanics I can get into, but there's so much that stands between an early employee and eventual cash. If you wind up joining a company like a Facebook, these powerful outcome companies, or even an Uber, then yes, you will get life-changing amounts of money, but that's such a lottery ticket compared to the amount of workforce that enters and gets early stage equity. So it's important, I think, to recognize, hey, I'm in for this mission. It's a lottery ticket that I can influence. Do I want to spend my time kind of living in the business, the industry, the go-to-market model, et cetera, of that business? If so, take that lottery ticket ride. It can be fun for a variety of other reasons for your career, but it's not necessarily going to be true. You can math it out in the early stage.
And just to close this loop, like you get Series C funding, and then is it IPO after? What happens?
Nowadays, not so much. Private companies are spending longer and longer in the private markets. They're finding it, appetizing to continue to get private rounds of funding, whether venture capital or otherwise, because they get to continue to exercise control over their company. They don't have to be, subject to all the needs
regulatory
of the public, regulatory scrutiny,
shareholder scrutiny,
exactly,
reviews every quarter,
exactly. And you'll hear there two competing forces in venture capital. These are really big voices like an Andreessen Horowitz or Founders Fund on one side of the equation going, stay private, we'll give you more money, we want it to be private, we want to run this show, versus Bill Gurley, who is of Benchmark fame, who goes, hey, these companies are going to be better off if they have this public scrutiny, shaping the executive team, shaping their go-to-market, but also allowing other people, allowing the public to invest in the moments where there's still a lot of upside for the public markets, which also tends to mean that these companies have an audience in their stockholders. So there are competing theories as to, should companies be staying private as long as they are, but nowadays you might be raising many hundreds of millions of dollars, sometimes even billions of dollars with these AI companies that are raising large financing rounds before you even consider going public.
All right, hold that thought. We need to take a short break, but coming up, we're going to be talking tech layoffs and a politically oriented venture capital runway showdown. Stay tuned. This episode is brought to you by the number 59,000. That is the number of tech workers laid off so far in 2025 through May. That's according to TechCrunch. Many of these are from some well-known names like Amazon, CrowdStrike, Microsoft, but also from smaller names like Chegg, Match, General Fusion, Beam, and others. So that's after 150,000 layoffs in 2024, which was, in my mind, not a bad year. Like, how serious is this getting? And then maybe tie it into AI.
Yeah, so I think there's two themes. The second one being AI. The first one being companies in general drawing back on what they think of as being reasonable budgets, headcounts. How much management layer do we need? What do we think of as being our entry-level workforce? This has less to do in last year or 2025's case with just like AI replacing anybody or augmenting anybody as it does with we spent too much money in this last phase of technology. We do not need as many people to execute on some of these broad business models. It's not literal math that people are doing, but instead executive teams going, okay, what didn't pan out in the last bet? What was more cultural than it was practical? So that, I think, has driven a lot of what has happened so far. Then you have the emergence of AI, and it's not, again, yet displacing people in like kind of a direct way, but what it is doing is it's telling people, do I want to invest in workforce? Do I want headcount that might be here for the next 3 to 5 to 10 years? Do I want to invest in a management layer that has expectations? If I believe that AI is coming in a way, and we're starting to see this augmentation where engineers, as an example, can produce a lot more code if they're using some of these tools, you don't want to, in 2025, invest in a big junior or mid-level engineering class because you'll have those people in 2 to 3 years. And so that's now this future forecasting that I think is impacting some of these headcount decisions. So it's a little bit of backwards, hey, this headcount stuff didn't work in the past, and forwards looking, let's not make the same mistakes, especially with AI in mind.
But this is weird, but are we just going to end up with many more companies with few workers? Because of the combination of what you were saying first with the advancements of AI, like it's going to be like Times companies buy 500,000 and they only have 3 people.
Yeah. And how do these younger workers get experience then if nobody wants to hire the junior level?
So that's a huge problem. The unemployment rate amongst the graduating class from college, whether you're in engineering or in any other field, it's really bad. So we've seen Derek Thompson wrote about this in The Atlantic, and other people are kind of looking at the graduation, undergrads, that cohort is currently not doing well post-graduation. So they're not getting exposure. They're not getting learning by osmosis. They're not in the office in the same way, and they're not getting these opportunities. It's not just a remote work factor. I don't know how we solve that. I think a lot of this is now going to be an onus on people to decide to self-train, and that has to do also with like what jobs will exist. So this goes to kind of the second category of what do we think is changing? Are there going to be a lot of small companies? I don't know if there are going to be a lot of small companies. Companies will certainly be smaller. So there are people in venture capital who are at the forefront of AI who believe this is going to lead to an explosion of entrepreneurship and all these tools are going to enable people to build their own businesses. But are all three of us, for example, going to want to build our own mug business and sell each other mugs? I don't know that that's actually what we want.
Well, maybe I just stay home though. Like if there's going to be a future way.
You're going to love
money.
the 2-day work week.
Yeah. I could read all day. Like as long as I'm making money though, by the way. Like,
well, this is where UBI comes into play.
Right? just passive income.
I do have a question though. Overall, like, are these tech layoffs, or is it a warning sign for the broader economy?
Yes.
Almost certainly. The thing with the broader economy that people don't quite, when people try to make this translation and don't quite understand it, is the broader economy requires more in terms of automation in the real world. For companies to make the same sort of forecasting decisions. And that requires an understanding of, okay, what will robotics be capable of? What will automation in the physical world be capable of? What will drones be capable of? And I think people even in tech, have less of an understanding because we can all play with ChatGPT, but not everyone has access to the latest that's going on in humanoid robots. So people are not there yet, even executives are not there yet. But I think that just requires, again, seeing the ChatGPT moment happen, let's say in robotics or in humanoids, and suddenly those same executives making this sort of choice with their software teams or their product development or knowledge worker teams will make that choice also with retail, with factory, obviously, self-driving. So it is a little bit lagging, but I don't think that'll last.
Yeah, it seems like at least a few years lagging. But you touched on something about the different levels, and I want to talk to you about ChatGPT.
Yeah.
I happen to subscribe to the pro version, and it is light years. 0.3
Fantastic.
with chain of thought reasoning, and then 4.5 with its ability to write scripts, for instance. It's just amazing to me, but it seems there's going to be this stratification, and for the average person, they're going to have a level of AI accessible to them that is just like not even a tenth, not even a hundredth, maybe not even a thousandth of what is possible.
Yeah, I think this is going to continue to be the case. This bifurcation of you get what you pay for. So right now we have the example. I'm also a subscriber to the pro version of ChatGPT. This gives us access to O1 or enough queries of deep research or O3, these models that are better than what, let's say, a free subscribers paying a lower tier are going to receive. That's the first set of bifurcation. The second set is actually when you just unleash cost. So the examples here are actually right now in the coding tools. So this is like a Claude code or an AMP code. And the interesting pricing model behind these is these are essentially charged on consumption. So a developer is using, let's say, Claude code to generate AI-driven code. And they're not paying, let's say, a subscription. There are some subscription models, but in some of these cases, it's just based on what you use. And what the companies are doing in this case, and they're going, we're not going to restrict the model in this case. When we're subscribed even at $200 a month to ChatGPT, OpenAI goes, we want to limit how much the AI does in that moment, because as the AI does more stuff, reasoning, using tools, it costs them money. It costs them compute. But if you tell the consumer, hey, you can have as much as you want, you're going to pay for it, you have programs, again, like AMP code, Claude code, that just run wild. The developer pays for it, but if they get high quality output, they actually don't mind. Now you have developers who are spending $200 a day on AI-generated outputs, and you're going to see companies obviously budgeting for this, where they're going to access not only high quality intelligence, to your point, at a different tier of pricing, but they're going to access a lot more of it because they're willing to pay the compute price. And I think this is going to be a bifurcation you see not just in code, but in other forms as well. So we are going to see there's the base layer of free or kind of accessible cost. There's the kind of subscription-based tier where the model makers are going to shape what you get, and then there's going to be get all the intelligence you want and in a fire hose, and that'll be priced at even a third tier. It's an interesting implication.
Just quickly, do you think there's any situation with adoption of things like ChatGPT on a paid level that would have any stigma attached to it, and people might not want to purchase that higher level? Like, oh, I use it once in a while, but I'm not buying the big version.
And we got to get to our next round too. We got multiple rounds here.
Yeah. There will be stigma, and you see it already when people can identify when you've used AI written, you can see the hyphens or the M dash, the N dash. I think that will eventually go away when people just realize how powerful we can all be if we're using the best models all the time. So stigma today, normalization tomorrow.
Oh, I love an M dash though.
Yeah, so do I. I use them all the time. And here's one. It's right in the script. Look at that. All right. Spotlight's up. It is time for a cap table showdown. Now, first up, we got this strip. First down the strip is a red cap rainmaker, strutting with swagger and a 50-tweet thread on regulation in his back pocket. He's not just talk. His firm hosts DC fundraisers as often as it signs term sheets. Now, close behind, we have the blue cap believer waving a net zero term sheet, promising impact and returns. He says his money is clean and purpose-driven. But is that a failure or a feature or just a label? And slipping between them comes this stealthy gray cap numbers ninja who lets the returns do all her talking. No press releases, no slogans for her, just cold, hard IRR and a giant, quiet pile of exits. Now, Sherveen, who steps off this catwalk with the hottest term sheets in 2025, either of the political firebrands or the stay out of it purist?
There are no purists anymore. You all have an opinion in venture capital. And so we have the class of folks who are very opinionated with what the capital is intended to do. So this is, let's say, the Andreessen Horowitzes of the world who say American dynamism, and they're, they even somewhat supported the current administration during the electoral process. And these folks are somewhat pointing, they're painting a worldview, and they're saying, hey, our dollars not only are intended to get us returns, we have a longer term theory of what nation states should be doing. Those folks are king right now. The problem is a lot of founders don't necessarily align with that worldview. And so the question is, over a long enough time horizon, do either new purists or people who do think about impact at the same time start to compete because they say, hey, look, this has become too opinionated as capital, right? And so if in 2025, opinionated capital in the form of Andreessen Horowitz or a founders fund, these very political firms where their originators or even current partners are activists, are currently leading the way, my hypothesis is on a 2 to 5 year time horizon, you're going to see pushback, and especially from a founder class that, again, might not align with the worldview that's being painted.
Any tips for making your pitch for funding to end on?
Series
Two
A
tips,
or
you
just
got
for
it.
an angel?
Two tips I give
tips.
everybody. The first is context is king. And so in a lot of pitches, what you see is people don't realize it's not just your pitch. It's like, do people understand or perceive what's important about your pitch? And you have to world build. You have to give people a little bit of context. So you have to tell them about the industry. You have to tell them what you know, what your secret is, what the insight is that you're building on beyond the thing you're building. And so delivering that context is king. The second thing, and this is probably what most people make as a mistake, is you want to be, I'm borrowing language from someone we had on our show, The Feedback Loop, a venture capitalist judge. The point in an initial pitch is to be compelling but not complete. A lot of founders will try to pour all the details, all the nuances, all the future cases they're going to solve. But the problem in that moment is the venture capitalist is new to what you're offering and can't quite rock it all. And so instead, if you're compelling but not complete, you're giving them enough to want the second meeting.
All good podcasts must come to an end. This is going to do it for this episode of Stocks in Translation. Be sure to check out all our other episodes on the Yahoo Finance site, mobile app, and we will see you on the next episode of Stocks in Translation.